your mind when what comes in your mind when we use word value? Because many times we interchange words like price and value amongst each other. And that is the reason my question to you, first of all, why what we think when we use word value. Any guesses? Be open with the answers, express your views so that I will be knowing on which track you people are understanding. Because we are now on last semester of MBA, we should be able to express our thoughts at the same time. We should know certain things which are at the background. Because in this valuation, we may discuss cash flow, discounted cash flow, time value of money in detail. At the same time, we can use words like CAPM model. What does it mean? What is the indication of these things? We should know. And that is the reason. If at all you are not knowing, let me know so that I can try to cover these all things which may not be in your memories. If you remember, well and good. If you are not in position to recall all these memories, we will have a glance on this and then we can proceed further. What comes in your mind when we use word value? Okay, fine. If you are not answering, then I suppose to answer. Price is the thing when we pay for fulfilling our need. But eagerness to fulfill that need can decide the value for that particular commodity. Because, see, we have ample of water. Are we valuing it? At the same time, we are having scarcity of petrol or fuel, and we are valuing that particularly because our needs are different. Even though without water we cannot survive, but we know the availability of this as a resource available around us. Value for that water is different. ऐसे पेट्रोल के जैसे टैंकर में जब पानी आएगा तो पानी हम गिरने नहीं देंगे, बट अभी पानी बहुत ज्यादा है तो वी आर ready to waste that water, even though it is important for our survival, right? That is from our normal life. I'm taking that example. But when we are correlating that terminology with the business, then this business valuation is nothing but the systematic process of determining the economic worth, or we can say financial worth, of business or company. Because small businesses, they may not find that much time to think on this valuation part. But at the same time, when we talk about company, specifically joint stock company, we try to find out their valuation, because ultimately their valuation, their contribution in a capital market plays a significant role. And then plus or minuses in stock market's value again impacts their position in a market. And that is the reason many times we have first thing in our mind, that is what should be the value of that particular company. What if we are falling short with the valuation thing? Basically, this valuation involves the application of financial theory, economic principles, and professional judgment to estimate what a business is worth at a specific point in a time. Valuation is essential for certain situations like mergers, acquisition, many times for the purpose of taxation, we value these things. Uh, if any litigations are there, like recently, Adani has faced few situations within a year, and many a times such a shocks comes in a picture when Adani and group comes in the market in the form of news. So that time we think on valuation of that particular company and its role in the market. When we want to restructure company, that time we need to think of valuation. So this business valuation is important by considering these all situations. I'll repeat these situations: when mergers will be there, when acquisitions will be there, for the purpose of taxation, compliances, if any litigations are there, even if we want to restructure our company, that time we think of valuation. When we are reporting in terms of finance, in, in other words, we can say for financial reporting, valuation of business is the first priority. I'll share one PPT so that you will be knowing. This is PPT come notes for you. Give me time for that. Of particular things with regards to capital structure, that is weighted average cost of capital, terminal value, then enterprise value, then present value of terminal value. What does it mean? Again, basically, when we do value or we call value, value term supposed to be understood very clearly. Value is nothing but the thing which represent economic benefit expected to be derived from ownership of an asset or the business. These benefit which we are talking now, we sometimes call that as a EBITDA, or sometimes we call that as the cash flow, expected cash flow from that particular business in future, because we are trying to forecast value of that company for future also many a times. So whatever we are going to use, we should know how, in which reference we are going to talk when we are talking about the valuation. It is the forward look with regards to value based on expected future benefits such as income, cash flow, or the utility which we are going to derive. I guess when we have discussed this value now, we might have in a position to exact differentiate this price and value terminologies. This value is the intrinsic calculation, or we can say number, which gives us a worth of the business based on the analysis of financial or the economic factors, whereas price is the actual amount paid in the transaction itself. When we are considering certain events, if in that particular events exchange took place in terms of money, that time we consider price paid for that particular incidence or transaction, and that is nothing but the price. Price may be different than the value which we might be considering for that particular commodity or for that particular company. Price may be different from the value which may think or thought by the owners. So it is just dependent on this price is just dependent on our negotiation power or negotiating skills. At the same time, how much is the urgency when we are going to procure that? If it is not urgent, we may not be in position to pay more price for it. If it is urgent, if any emotional factor is attached, if and if not attached, situations are different, and accordingly, being a human, we behave. At the same time, if market conditions are in favor, then value is different. Market conditions are not in favor, then value is different. So price is different thing, and ultimately value is different thing. Now, first thing comes in my mind when we talk about this value and valuation of companies or businesses, then who is responsible for this valuation? Who is responsible for this valuation? Any guesses? Who is responsible for valuation? For valuation, certified valuers are there, chartered accountants, investment bankers, financial analysts, CFA, chartered financial analyst, registered valuer under regulatory bodies. Which are the regulatory bodies then? SEBI is one of the regulatory body. If valuer is registered under that particular regulatory body, he has authority to value that particular business. Valuation firms and consultancy organizations are responsible for valuing business. Now, as I said earlier, and we have discussed, why we think of valuation. In which situation it comes in picture? First thing was when mergers and acquisition we want to think for our company, then ultimately we need to think of what will be the value of my company and what will be the other company's value. Accordingly, certain terms and conditions will be set. That is the reason when we are thinking of mergers, acquisition, then that time valuation is must. When we want to sell or purchase any business, any kind of business, that time when we are going to do that particular thing or action, that time valuation of that particular business is mandatory. Taxation, or we can say as the compliance part, we have to fulfill taxation requirement. For that particular taxation and estate planning, we have to value the business. If any disputes are there, we have to value business. Corporate restructuring, IPO, if we want to raise fund through IPO, we have to think of first existing value, then we can think of what will be the price of that particular IPO in market, how much fund can be generated. This is how various situation may come in picture where we have to value our business. Then there are certain principles which supposed to be followed when we are going to value business. Which are these principles? Which are these principles? First one is principle of future benefit. What will be the cash flow? What will be the net operating profit? No PAT after tax. Then their forecasting. Value based on expected future economic benefits. We are starting business for indefinite period of time, but for few years we may think of what will be the position of business in terms of profitability, in terms of benefits. So ultimately economic benefit will come in picture. Then second one is principle of substitution. An investor will not pay more than the cost of acquisition or acquiring that similar asset. So we need to think of how much is the value of our assets which are holded. Accordingly, investor we may think of. So that is the reason principle of substitution comes in picture. Earlier we have seen one principle for valuation, that is principle of future benefit. Then second principle is principle of substitution. This principle is talking about the assets valuation. Now third principle. That third principle is saying when we are valuing the business, which principle supposed to be taken into consideration? Then supply and demand study. When we are saying supply and demand study, because if your company's product is demanded in market and accordingly your company is fulfilling the needs, then situation is quite well. Your supply is abundant but no, there is no demand, then valuation will face the impact of such a thing. That is the reason we should study in detail the economic environment in which our company is going to operate functions in terms of the competitor's strategy we should know, what will be the supply of that particular commodity from market and our company specifically to meet the expected demand or existing demand of the market. So in detail we should know ultimately the things like market forces influences the value, and that is the reason these all minute or minor things from the market are important to be studied for getting the principle of supply and demand for the purpose of valuation. Then fourth principle which has to be taken into consideration, that is principle of risk and return. See, I guess in SAPM subject of finance specialization, we have studied this risk and return in detail. Have you opted this SAPM in earlier semester? Anybody from student who will answer this? So this principle of risk and return, if at all you have not studied in SAPM, just go in details of this risk and return as per the SPM syllabus. And if at all you are finding it is difficult to be studied, let me know so that I can cover that particular part. As we all are knowing, principle of risk and return is saying higher is the risk, higher is the return expected. In which business segment your company is operating function? Is it a risky one? Whether the commodity is risky? What exactly risk you mean to say in this? It is the intrinsic risk, whether it is the market risk, whether it is any other kind of risk involved. So, first of all, risk has to be defined properly. Then it has to be correlated with the return. Then last principle which we suppose to consider for valuation, that is the principle of highest and best use. Highest and best use is corely concentrating asset value which depends on most profitable use. So whatever is the valuation of asset is not only the important, that value of asset which you are holding is in the position to convert that into profitable use, profitable business, that is going to help for the purpose of valuation of business. So which are the principles for valuation? First principle is principle of future benefit. Forecasting should be done for the profits. Then on that basis, you can value business. Principle of substitution, it is saying what is the worth of your assets which are acquired. Principle of supply and demand is forcing to study market forces, economy in detail, so that whatever the responsible factors are existing, then it has to be taken into consideration and then valuation will be done. Then fourth one is principle of risk and return. Risk supposed to be calculated, and on the basis of calculated risk, segregated risk, returns terminology will be assigned to it. And last principle is principle of highest and best use. Holding asset is not is sufficient. Along with that holded asset, its conversion in terms of profitable use should be there. So ultimately, These are our 5 principles of valuation will be taken into consideration for valuation purpose. Now, when we talk about business value or valuation in terms of business, then basis of valuation should be taken into consideration. See, we have studied income tax also earlier, and being a finance person, we should know income tax, at least certain basic fundamental concepts, whether it is our as per our syllabus or subjects which we have chosen for the study or not. But we should find interest and we should know. There is no excuse of having knowledge of these subjects. And that is the reason when we talk about income, from income tax point of view, income is nothing but certain extra monetary benefits which are derived after certain financial activities, whether it is the activity in terms of investment, whether it is the activity in terms of work, which we might have undertaken, against which we might have considering certain consideration. That is nothing but a salary. So when we talk about income tax, income sources we consider, one of the income source is salary, second is house property. And in house property, we have studied standard rent, fair rent, all these things. These standard rent, fair rent, again, instead of using rent word, here we are using value word. But when we value property, we consider that because these standard rent, actual rent received, or we can say fair rent, municipal valuation, these are the nothing but terms used for valuing certain property. In business, we are going to value assets. One of the asset is nothing but physical property through which or due to which we are running business. That may be the factory premises, that may be office premises, and so on. So, few things are common. If you are able to link it, you will be able to remember these things. First term which we supposed to consider when we are discussing value, that is the fair market value. Who decides this? And how we can say it is the fair market value? The price at which property would change hands between a willing buyer and willing seller, both having a reasonable knowledge of relevant facts and neither under compulsion. Nobody is forcing. Am I forcing anybody to buy? No. Being a seller, I should not. I should give proper idea about the product which I am intended to sell. Whereas one who is a buyer, he should have an intention to buy by considering the market situation. And when both the parties are not having any bad intention to do that activity and they are having awareness that time where they should know and they are in position to think of what will be the fair market value. Economic conditions derive that fair market value of particular company. Then another term which is there mentioned in your syllabus, that is only fair value. What does it mean? This is nothing but this fair value is used in financial reporting or in legal context. It represents the value determined in accordance with accounting standards This is determined by considering financial reporting and legal context. It represents the value determined in accordance with accounting standard and court decision. This fair value is again used for legal context. Excuse me, I'll have a sip of water. So this fair value is nothing but the term used when we are considering the legal things. Instead of fair market value word, we use fair value word. So investment value. This investment value is what? It is nothing specific investor based on individual requirement, expectations, and synergies. The investment value is decided by the investor itself. His requirement, expectations, and synergies are responsible for deciding investment value. Up till now, value terms we have studied. One is market value, fair market value, fair value, and then fourth one is investment value. Then next term is intrinsic value. What does it mean? See, we do in analysis, one is fundamental analysis, another one is technical analysis. When we think of business investment in capital market, or for that matter any financial market, we try to analyze situation fundamentally. If fundamentals are strong, we believe our investment is safer in long term, because fundamentally few things supposed to be clear. So inherent value of business is based on which factor? It is nothing but the fundamental analysis. This fundamental analysis is talking about mission, vision, their balance sheets, their forecasting, their way of functioning. If it is based on certain estimates, everything supposed to be on paper with certain proof. Everything supposed to be there on paper with certain proof. That is called as a fundamental analysis. When we are knowing the past records of the owners of company, their belief system, their vision, and their certain performances in terms of financial things, figures, that time After calculation, we come out with certain conclusion whether it is going to favor us when we are investing it. So ROC for that matter, ROI for that matter, we take into consideration. When we talk about this intrinsic value, this intrinsic value is wholly dependent on what I can say. Is valued. Certain situations are responsible, which are forcing us to value business by considering all these factors. So, these circumstances are responsible for valuation of business. This is called as premise of value. Then, as we all are knowing, when we think of business, think of certain concepts and conventions. In last year also, we have studied few and conventions in management accounting. What what all are there? Like dual aspect, separate entity, going concern, likewise. One of the concept is the going concern, and this going concern concept is saying us there is no fixed time for business. We feel that human being has a tentative lifespan of 100 years, not more than 100 years. Nowadays it is near to, in even though lifestyle is improved, standard of living is improved, today generation is surviving around 80, 85, but chances of people, those who are in young age like me, survival may not be beyond 60 because of this hybridized food. Whatever it may be, the things are certainly defined for human beings. What about business? Business may not have that much limited time span for the operational purpose. Like Tata Empire is operating their businesses over 100 plus years. We have another example from our Indian history itself, that is the Ambani Group. Even though this business have been started by Dhirubhai Ambani, after Dhirubhai Ambani also there are people who are taking care of that Ambani Group's different enterprises, business operation. After split also, these two brothers are taking care of business, and now third generation is ready to take care certain business activities. If you have already started to doing their functions in respective domain or respective companies, so generations are passed from natural human beings, but companies are operating their functions over a period of time. Ultimately, what does it improve? It is what will be the tentative life of that particular asset and how much utility we are going to receive in terms of cash flow. If it is going to give us a positive return, then and then only we invest. Otherwise, we stop investment in that particular asset. Then next is liquidation value. We got to know who are responsible for valuation as in terms of authority, but we should know what will be the liquidation value. Then, who is doing that liquidation? Government official known as liquidator is doing that liquidation process, and for that he is trying to value assets of company for liquidation. This liquidation value assumes the business operations will cease and assets will be sold individually. It may be orderly liquidated and force liquidation. Liquidation may be due to any reason may come in picture. By order it may, and it may be by force. If it is by force, then also liquidator is required, and if it is by order, then also liquidator is required. He is the person who is trying to value assets and is nothing but when we define first one, purpose, why we want to do this valuation, in which business it is, what is the purpose behind the valuation. Then second step which we supposed to do, that is gathering the information. This information may be financial, this information may not be from financial background, but general all kinds of information supposed to be there, because and a business environmental ecosystem is affecting business. That is the reason that ecosystem of business should be known and should be considered in terms of information for valuation purpose. So first thing is knowing the purpose of valuation, then second is gathering the information, financial and non-financial. Third one, which we supposed to know, that is the analysis of historical performance. Past performance, if it is known, then it has to be analyzed. It has to be checked. Then fourth one is appropriate valuation approaches supposed to be taken into consideration. What does it mean? Then it surely mean there are certain techniques for valuation. There are certain techniques for valuation. Net asset method is there. Cash flow related method is there, which is forecasting the future cash flow whose present value will be taken into consideration, and then valuation will be done. There are certain steps which we supposed to take into consideration when we are going to use. Based on that, numericals are there, and by considering these numericals we value the firm. Next step, after selecting appropriate valuation approach, applying valuation methods. Just selection is not sufficient. Actual action on these particular methods which we might be knowing, but one of the method we will select, and accordingly action will be taken into consideration report for valuation. This is how we do the valuation. Now, when liquidator is doing this valuation, that time he's priority list first, then unsecured people, unsecured loan if it is obtained, then preference shareholders, and last chance that comes in picture, that is the equity shareholders share when they'll be paying back from company on their invested amount. Because even though capital is invested in a company, it is a liability for a company by considering separate entity concept. Two concepts are again here we are discussing, which are from first semester. That is, one is going concern concept, which is again mentioned in your syllabus specifically, but which is not mentioned but has an impact when we do the valuation. That is nothing but the separate entity concept. Now, last point of today's discussion, that is the valuation standards. Valuation standards provide professional guidelines ensuring what they are ensuring consistency and credibility. Consistency should be there when businesses are performing their business operations, but in terms of accounting, when we think of consistency, then methods which we are including in accounting should be consistent enough. This time, if we are using written down value method for depreciation, then next year it is expected that you should do the depreciations calculation by considering written down method. But last year you have used straight line, and this year written down if you want to use, then such a thing should be avoided, because this needs to be taken into consideration. In depth impact, what will be the impact and what was the impact should be taken into consideration. Proper clarification should be given why change you have taken, and many things are attached with it. So it's better to be consistent than the fluctuating style which we may think of opting. But businesses are not allowing us to fluctuate. They are expecting that whatever we will be doing, we will be doing consistently, whether it is a matter of recording also. And then most important part, that is the credibility. What does credibility mean? Ultimately, small or big enterprises in a business environment are operating their functions or businesses on just on the basis of publicity. Publicity, if we use mouth publicity, then it's serious matter of concern when it is business. It is not just matter of discussion. It is serious matter of business when we operate our business functions in the business environment. It is going to create bad impact in market. You may lose the market valuation, because if third party starts saying you are not ready to meet your creditors requirement, if they are asking for a fund, nobody will stand by you. Everybody will start asking money which they might have invested in company. So ultimately in this situation, financial crisis may comes in picture for a company, and company may collapse while operating business functions. So credibility is playing important role, and that is the reason we study in second semester few ratios which are only focusing on liquidity aspect, because this liquidity is helping us for deciding credibility. Not only that, our income generating capacity is also responsible for thinking of credibility. If we have good income source, people will support us. If we are falling short with income source, people will not support us. They define ethical requirements. Who defines these business standards? Define ethical requirements and reporting format and methodology, which is supposed to be followed consistently and where credibility is core matter of concern. Now, for that purpose, example includes international valuation standard IFRS, supposed to be taken into consideration. National regulatory authority is also regulating it. So business valuation is difficult to be tackled, but it is needed many a times. So valuing it is must. Today we have gone through theory part of business valuation. Tomorrow we are going to discuss, if possible, the numericals of business valuation. I'll stop today. Have a nice day. Sir, can we stop session right now?
Yes, ma'am.